Chapter 5, there's 3 sections to Chapters 5. There is provisions, riders, and options. So we're going to go ahead and go into Section 1, which is common policy provisions. So common policy provisions, first thing is entire contract. It's just everything in the contract plus a copy of the application. Okay, the insuring clause is the company promising to pay the death benefit. So it's like them saying, like, if you get a policy, what's going to happen is they're going to promise if something happens to you or anyone in the policy, they'll pay a death benefit. Consideration. Consideration is something of value that each party brings. Now, it is a concept that we went over in previous chapters, but I'm going to go over it again. Consideration for the insured, for the client, is the premiums, right? The payments and any statements they made on the application. If they're talking about the company or the insurer, what do they bring to the policy? They're going to bring the death benefit. Next thing is owner rights. So as a policy owner, if you are the owner of a policy, it means you pay the premiums. And as the policy owner, you have certain rights. And one of the rights is assignment or transfer of policy. And what this is you have the ability to give ownership over to somebody else, right? So there's absolute assignment where you're giving all ownership to somebody else. And there's collateral assignment where you're giving some or partial rights to somebody else. So you still have ownership, they have some ownership, you have some ownership. Conversion privileges. You have the right to change your policy from a term life to a whole life. You have the opportunity to do that as a policy owner. Selecting and changing premium modes. If you like, because you are paying the premiums, if you're paying monthly right now and you decided, you know what, I changed my mind, I want to go to annual, you as the policy owner can call the company and change it. Okay, cash value, dividends, and surrender charge. I'm going to go briefly into them, but if you want more details on these 3 things, you want to go into this 3rd section of Chapter 5. So cash value is like a savings, right? It's like a savings attached to a policy, and you have the right to take that money and have that money for yourself. Dividend, okay, dividends is basically like you've overpaid for your policy, there's money left over, and that money needs to go to you. And the last thing is surrender charge. If you as a policy owner decide to take the money out of your policy, like the cash value, decide to take it before you're supposed to, right, early, it's basically like you're giving up the policy sooner than you should be. If that happens, the company will charge a surrender charge to the policy owner. Free look period, we went over in Chapter 3, but the free look period is the time that the client gets to look through their policy and decide, is this really what I want, right? And if they decided that they don't want the policy that they have in their hands, then they can go ahead and cancel the policy and they will get a full refund. Now, you obviously have a certain amount of time to do that. It's 10 days for anyone that's 60 and under, 30 days for anyone 60 and over, and 30 days for replacement, okay? And again, it starts when the policy is delivered to the client. Next column over, payment of a premium. It's just the who's and what's of your premium, right? How much are you paying? To who are you paying? When are you paying, right? Just the who's and what's. Grace period, again, also something we went over in Chapter 3, but again, grace period is if you miss a payment. If you miss a payment, you'll get 30 to 31 days to pay back that payment, and if you don't, then your policy will lapse. Lapse means cancel. Okay, but let's say your policy did cancel, it lapsed, right? And you decided, you know, a couple months later, you're like, hey, I want that policy back, right? Because at this point, you don't have a policy. You decide, I want it back. If you decide that, the company can put your policy back, right? It's called reinstatement, to put your policy back. Okay, so you have 3 years to do 3 things. So obviously, companies are not going to say, Yeah, sure, just come back in. Like, no, they're going to make sure that you requalify. You have to requalify. So first thing is you need to provide evidence of insurability. You need to provide health and everything again, because there's sadly a lot of cases where people let their policies go, and then months or years later they find out that they have some sort of illness that would cause them to not be able to get policies anywhere else, and then they come back trying to get the policy back, and now because of their health issues the company can't cover them anymore. Number two is you need to pay back all premiums that you have missed from before the policy lapsed. So if you missed any premium, they are going to charge you that still, because you were still covered in that month. Okay. And the last thing is, if you have a cash value policy, then any money you took out of the cash value, you need to pay it back. A policy that was surrendered, a policy that was given up sooner than it was supposed to be, you cannot reinstate those policies, because once you surrender, it's gone. You can never get that policy back. If you wanted a policy, you'd have to go and get a brand new policy. Incontestability, this is something that we've talked about in other chapters. So incontestability, 2 years. Just remember that, incontestability, 2 years. So after 2 years of having your policy, you get something called incontestability, which means the company cannot fight a claim. So basically in the first 2 years, the company can try to fight a claim, find a loophole to not pay out. But after 2 years, they can't do that. So basically think incontestability, 2 years, okay? Misstatement of age or gender. So obviously when it comes to age, the older you are, the more you pay, the younger you are, the less you pay. And some people know that. So when they do their application, they actually state that they are younger than what they actually are. Now, what happens if the company finds out about the person's actual age? They're not going to cancel the person's policy. All they're going to do is adjust based on their actual age. Right? Now, what happens if the person passed away? Now, what we're going to do is adjust the death benefit. So when we pay out the death benefit, we won't pay out the amount that they had originally been covered for. We would pay out the amount that they would have been able to get with the amount of money they put into that policy. Now, gender, same thing. If someone states the wrong gender, they're going to adjust based on the correct gender. Exclusions. Exclusions are things that are either not covered in a policy, or if they are covered in a policy, the person is going to pay more premium. Now, there are some things, again, in the book that you'll see that you'll go, wait, does our company do that? And remember, guys, that this isn't a Primerica test. This is your state test. Everyone takes the same test. So exclusions is something that Primerica, we don't have exclusions, but other policies definitely do. So that is why we go over them. So these are common exclusions. There's a bigger list, right? But these are the most common ones you'll see on your actual test. So again, either exclusions is they won't cover the people, or they will cover them, but they're going to charge them more. So first thing is aviation. Aviation is flying planes. Now, the flying planes is not like the person that works for Delta or United. It's going to be that person that, decides, wakes up one day and they're like, oh, I'm going to learn how to fly a plane. Like, no, you don't need to fly a plane. You're putting yourself at risk. So that is why some companies won't cover, or if they do cover, they're going to go ahead and charge the person more money. The next one is hazardous occupations or hobbies. So this would be something like skydiving, bungee jumping. These are hazardous hobbies, or an occupation that might be considered hazardous is someone that works on like construction, like skyscrapers, things like that. That's a very dangerous job. So those people that do those things, they'll either won't get covered, or again, they will be covered, but they're going to pay more premium. And the last one is war or military service. So some companies actually don't cover military. And an example of not covering war is 9/11. 9/11 was, once they announced that it was a terrorist attack is an act of war, right? And the moment I said that, a lot of companies said, oh, that's an act of war. We don't cover acts of war, right? So then a lot of companies did not pay out their death claims because they said, we don't cover war, it's an exclusion. Suicide, if you commit suicide in the first 2 years of your policy, then the company won't pay out. All they'll do is give a refund back to the family of anything that person put in. But if someone commits suicide after the 2 years has passed, then the company will pay out the full death benefit. Okay, next page. Beneficiary. A beneficiary. What is a beneficiary? That is the person that's going to get the money when you pass away. Now, you can put anywhere, anyone or anything as your beneficiary. So any individual, anything. So if you want to put your cousin, your best friend, a random stranger you just met on the street, anyone can be your beneficiary because they're not covered in the policy. They're just in the policy stated as a person to get the money when you pass away. Now, minors, you can also put a minor as a beneficiary, but it's not something we suggest because what happens is if someone passes away and the beneficiary is a minor, the minor will not be able to get the money until they're of age. So if you see a minor, if you go down here, you see trust, that's where the money is going to go if the person is a minor when the insured passes away. So a trust is where the money goes if the person that is the beneficiary is a minor. Classes. So a lot of people say, oh, my kids or my siblings or things like that, right? So if you say stuff like this, there's two ways we can split it. Per capita, if you speak Spanish, maybe you'll understand it like per cabeza, right? Per head. So if I said, there's $100,000 in death benefit and there's 4 kids, and they said, oh, my kids, that means each kid would get 25 grand, right? Because they split it evenly per head, right? Now, per stirps is more like bloodline. So let's say I put my sister as my beneficiary. If she passes away before I pass away, her kid becomes my beneficiary, her kid's kid, her kid's kid. It's kind of like who's next in line until I pass away, that's the person gonna get the money. So I don't need to change my beneficiary, it'll just go to the next person in the line. Estate. So if you do not put anyone as your beneficiary, automatically your estate would be put as a beneficiary. And your estate is your net worth, okay? Your net worth. So if no beneficiary was stated in the policy, then automatically your estate would be named as your beneficiary, and your estate is your net worth. Okay, successions. The successions is the order in which your beneficiaries get the money. So primary is the first person said to get the money if you pass away. So if you pass away, your primary gets the money. Now, what happens if your primary passes away before you do? Then you have a contingent, or if you see in parentheses, there's secondary, tertiary. These are all different names for the same person. This is that person's kind of like the backup beneficiary. So if your primary passed away before you did, the contingent would get the money if the primary passed away. And the only way that the contingent will ever get money is if the primary dies before the insured. Now, knowing this, what if the primary beneficiary and the insured are in the same car together and they get in a car accident? They die same day, same time. What happens? Now, if the insured, right, the person covered in the policy, if they pass away at the scene of the accident and the primary dies in the ambulance, right, driving away, who died first? The insured, right? The insured died first, primary died second, and I said the only way the contingent would ever get any money is if the primary died first, and that wasn't the situation. So what happens? Supposedly the primary is supposed to get the money. So if you look in the second column where it says common disaster clause, the Uniform Simultaneous Death Act basically says if the primary and the insured, if they die within 14 to 30 days of each other, the company for the life insurance, right, for the sake of the life insurance, they're going to say that the primary died first, then the insured, so that the contingent could claim the death benefit. Even if, let's say I'm the insured and my sister is the primary, even if I died on the 1st of a month and she passed away, 2 weeks later, or let's say a week later, I obviously passed away first, but for the life insurance, part of it, they're going to say that she passed away first, so that whoever I have as my contingent, that person would get the money. Okay. Now, if we go back up to the revocable and irrevocable, revocable is changeable. Revocable, changeable. Means that you can change your beneficiary to whoever you want, whenever you want. So, oh, I want you. No, I want you. No, I want this person. No, I want this to my sister. I want this. You can keep changing it to whoever you want, whenever you want. Irrevocable, on the other hand, an irrevocable beneficiary, it means the only way you could take an irrevocable beneficiary out of your policy is if they give you written consent to do so. So let's say I have my mom as my beneficiary and she's an irrevocable beneficiary. What does that mean? If I want to take her out of my policy, she has to give me written consent saying, yes, Sarah, it's okay for you to take me off your policy. If she doesn't give me that, she will stay there as my beneficiary. Okay, spendthrift clause, or the right of beneficiary and creditors. I always think of like the spendthrift clause as the creditor clause. Okay, it protects your money from creditors. So let's say you pass away and you owed money to a creditor. If that's the case, some creditors most likely would find out that your family is about to get a sum of money, and what will they do? They're going to go and say, oh, that person owed us money, give us the money that you're about to get from the life insurance policy, right? Well, because of this clause, they actually can't do that. They have to pay, they have to be able to tell them about it, but they can't say, give me the money for it, right? If your beneficiary wants to pay your debts off, they can, but that is their choice. They don't have to do it. Policy loans. Policy loans are only found in cash value policies. So term life policies do not have loans. So cash loan is you're taking money from the cash value and it's upon request. You ask for a loan, they give you the money. Automatic premium loan is something that happens automatically. So they're taking money out of your cash value, most likely to pay for the policy, to pay for the life insurance part. So if you see right here, second bullet point, it says that this loan prevents the unintentional lapse of policies due to non-payment of premium. So they usually use this as like a backup, so that if you don't pay your policy is still active, not because you missed something. Okay, so that is the end of the first section of chapter 5.